Hi, so this is the third episode for Fintech.TO, and today I'm going to explain a little bit more about one of the financial industry, and I will start with the insurance industry. I actually spoke with a person who works in the financial industry, but instead of going to the details how the industry works, I would just go to the major players and then focusing about how they make money and how they manage risks and the general dynamics. So the topic is about insurance industry. And the insurance industry from the consumer perspective seems to be very easy, right? If you have a car, you want to get an insurance, you just go to a website or to the bank branch and then you just ask for insurance for your car, and they will offer you a huge amount of choices about the coverage. If you want a coverage about if somebody steals your car, or there are some mandatory kind of coverage that you have to get that everybody has to get anyway, and then we'll be asking questions about how much time have you driven so far, what kind of why you want to drive, and then based on that question and the answers that you give, they would come up with the price of the policy. And now we are going to something very specific about the industry. So the consumer, from the eyes of the insurer, is called the policy holder. The insurance company itself is the insurance company, and that's usually what the consumer sees. So the consumer or the policyholder promised to pay on a monthly basis, or depending on the period, a fee, and that fee goes to the insurance company, and the insurance company promises to the consumer that if one of those conditions triggers from the policy, let's say there's an accident or somebody steals a car and things obviously are proved to happen in that way, then there's a payout to the policy holder, right? So it's kind of like a gambling, but in the opposite way, right? Now, the industry is actually more complex than that. It's not just about the consumer and the insurer. Actually, there's four different types of players in this industry. So we have the policyholder, which is the consumer, and then we have the insurer, right? And then we have the re-insurer, the insurer of the insurers, right? And finally, the investors. In this industry, what happens is that the insurer collects the money from a lot of policyholders, and in the best case scenario, there's no sinister or there's no payout, so the insurer can just keep the money to themselves, and they can actually, depending on the jurisdiction, do whatever they want, just like a bank. So they can actually use the money to borrow more money and make more investment, or they can use the money to buy another company that generates income to the insurance company, right? This is like the perfect scenario, but in life, that's not the case. Usually, there's a X amount of probability for those policyholders that will, request a payout because something happened, and then they usually have to use the money that they have and pay back to the policyholder. Now, but then he's like, hey, wait a second. You said that there's a re-insurer. What is that? Yeah, so for smaller insurers, in order to provide more policies, more type of insurance product, sometimes they don't have enough money, right? Or enough scale to provide certain kind of risk management. So for instance, a small insurer that is focused on auto insurance, they might not be able to insure a house because it's just like the magnitude of the amount are different. A car costs 20,000, 30,000, but a house costs 300,000, 500,000, 10 times more. And if something happens with the house, they might not be able to actually pay back to the policyholders. But they also want to keep the client within their circle. So how they do that? They work with other insurers that might not have the client, but they have the financial backing. So what happens is that the reinsurer will give sets of rules or the type of policies that they are able to give, and the insurer will try to sell that new policy to the consumers. So at the end of the day, not only the insurer is selling their own product, but they could also be selling insurance from other companies too. Or they can share the risks. So for instance, instead of like having, let's say that the insurer, the direct insurer is going to insure to the policyholder for certain kind of risks except the stealing part, right? But there's actually another insurer or reinsurer that, given a certain fee, they can also give that kind of policy or trigger to the consumer. So that's how the insurers and the reinsurers works. In special, actually in certain kind of big projects, let's say launching new satellites or building new rockets and things like that, usually there's no such a thing like one insurer that is specialized in rocket launches or satellite launches and things like that. Usually a group of insurance companies will come together and try to offer this policy as all together. So usually you have this insurer that it's not a facade, but will concentrate, hey, we are selling to, let's say, this rocket company an insurance policy for $100 million, but behind the scene, this insurer is selling parts of that insurance policy to other insurers or reinsurers. In that case, the insurer is called the seizing insurer. So the company that is sharing the risk, and the reinsurance company is the one that is buying that company, right? So that's actually how it works. So you usually see companies that have these kind of like reinsurance, right, for these big insurance policy companies, and the insurance company itself, the reinsurance company itself, can use the money that they collect with the insurance company to funds and buy other companies in order to generate and make more money, and hopefully if there's any issue with their customer base, they can actually have enough monies to pay out, right? And there's a lot of different types of reinsurance, but this is not the focus. I'm just trying to tell the overall of the industry itself. Now, and the last part of this industry is actually the investors. So the insurance company, they can actually make these policies they can bundle policyholders together by different types of risks, and they can actually sell this to other insurers companies, or they can sell it to the markets for investors who are willing to take that risk. So they buy these bonds and they receive certain payouts, but if the monthly, let's say, payment from the policy holders, but obviously if there's payout, then the investor has to pay it back, that amount, right, that the policyholder has to receive. So there's this kind of processes out there. And again, there's obviously regulators, government looking in this industry, but this pretty much summarizes the insurance policy, and it's important to understand how this works, like how these insurance companies makes money, receive money, try to invest, and the surplus is the profit, and the payouts obviously are the cost plus the operational cost. Because a lot of the startups in the fintech industry that tries to tackle the insurance industry, they are just doing the very beginning of that relationship of being the insurance company that sells to the consumers via web, but they don't actually hold any risk because they are working with reinsurers and selling that policy or parts of it back to other insurance company that will actually be doing the financial management part of the risks, right? So that's actually very interesting to understand, because further on in the other blog post that I will be making, we need to really dig deeper into this and see how the new fintech startups in the insurance company are actually going to disrupt this specific sector of the fintech world, right? So this is what I'm talking about for today: insurance company and the industry and the 4 different type of players. And for next week, we'll have more about fintech. So see you soon. Have a great night.